Hi there and welcome. Michael Beresford's my name and I'm the Director of Investment Services here at OpenCorp. And I've got a really special guest with me today, our GM of Mortgage Broking and all-round financing superstar, Amanda Gleig. Amanda, welcome.
Hi Michael, thanks for having me today.
I can't remember the last time you called me Michael, but that's good. Well, look, for those of you that are regular viewers to our monthly webinar series, you'll know that we love to bring a lot of industry insights and data and specifics to you from experts so that you can stay informed and across the latest developments in the property investing landscape. I'm really passionate about helping our clients understand the fundamentals that drive markets and get results, as opposed to the headlines that create hysteria out there in the marketplace. So that's exactly what we're going to be getting into today. What is the important stuff? Where does the rubber hit the road? And exactly what do you need to know around property financing strategies? I'd go one step further, even property financing fundamentals. As we know, finance, for anyone that's been through the process, can be pretty daunting. It's not an easy process dealing with banks and their endless list of document requirements, as I'm sure, Amanda, you can attest to.
Absolutely.
Yeah, but look, fundamentally, unless you've got bucket loads of cash, banks and loans are going to need to come into the the property investment process somewhere along the line. We're going to need to get banks involved. So what better thing to focus on, especially given some of the recent APRA announcements around property financing and what are the strategies that we need to be successful property investors, as opposed to just going to the bank to get a loan. They're very different. So we've got a bucket load of really interesting insights. We've got some fantastic questions that have been sent through from registrants prior to now, and we'll be working our way through all of that and helping you understand what some of those key concepts are around finance and investing as we go. So, at this point, I guess I do have to say that while we're talking about finance and money today, all we can do in a public forum is to share general information. You probably know exactly what's going to come next. Every person's individual situation is going to be different. Absolutely, we can sit down and take you through an assessment of your individual situation and how we can help. If you don't know what your borrowing capacity is, absolutely, that is the first step in starting your property investment journey, or the first step towards your next acquisition in your property investment portfolio. So what we're going to be going through today are fundamentals to be aware of. What are the essentials and how can you take advantage of the lending landscape right now? So at this point, if you have been looking at your borrowing capacity and you understand that already, and you're understanding what kind of investment strategy can work for you, click on the button below and my team can take you through that. If you haven't looked at your borrowing capacity, never fear, click on the button below. Our team will get in touch and we can help you understand that in the first instance. But look, without further ado, let's get into the fantastic insights that we have for you today with Amanda, our GM of Mortgage Broking, as I said, and get her insights on the lending landscape right now and some of the investing essentials. So Amanda, great to have you with us. I know you're really modest, so I'll give an introduction to you. I'm sure you won't mind people knowing that you were a client of OpenCorp's several years ago before you actually joined the team. And one of, I guess, the most amazing things about what you do is not only the outcomes that you get for clients in terms of what you save and the clarity that you give them around the process, but having averaged month in, month out 9.8 on your customer CSAT scores out of 10 is an exceptional result. So lots of happy OpenFinance clients out there that you've been able to help, and thanks for taking some time out of your busy schedule to give our viewers some insights today.
Oh, it's a pleasure. It's so exciting to be a part of the journey with yourself and the OpenCorp team, and really just to hold people's hands through that investment journey. As we've talked about many times, that finance part of the experience can be such a daunting and scary part of the process. So having been through that process myself, starting out as an investor and then I guess moving into the finance space has really, helped me or put me in a good position to understand exactly what clients are experiencing and link that back to my own experiences. So yeah, it's great to be a part of the team.
Yeah, it's a really interesting point that you make, because the finance landscape, it feels like it changes on a daily, weekly, fortnightly, monthly basis. It's constantly changing, right? And so I guess the insights that we're able to provide today are what's happening here and now, but we're going to talk generally about what are the things that change and how people can get the can get the best outcomes, because it's impossible to stay on top of all of the changes as they come into the lending landscape, isn't it?
Very much so. We get emails usually on a daily, if not a weekly basis, with a change to different banks' policies or assessment, criteria. So it's really important that we stay across that, but then we're also able to help clients to navigate that space.
Yeah. Well, I guess the first question I've got for you today is around leverage and what it is and how it works. But for maybe some of the beginners out there, I might just give an example before you apply it to the lending situation. So some of you watching might have read Cam McClellan's book, My 4-Year-Old, The Property Investor. And in there, Cam does a side-by-side example of property versus shares. Now, this is a great example because it helps you understand the power of leverage, or OPM, other people's money, as Cam calls it. A bank loan in basic English, right? And the example that he uses is that if you invest 50,000 of your money in the share market, then and you take a loan for the balance, then effectively with shares, banks will lend at let's say a 50% loan to value ratio. So that means they'll take your 50,000, they'll add 50,000 to that and give you 100,000 invested in the share market, where their exposure is half of that total amount. Okay. And whereas with property, if you invest 50,000, then banks will allow you to have up to a 90% leverage or 90% LVR, where you could take your 50 and couple that with a $450,000 loan to have 500,000 invested in the property market. Now, if we take, so that's the same amount out of our pocket, but if we're taking a 20-year view, then shares, let's say that they grow at a superior capital growth rate at 10% per annum, then that 100,000 invested in the share market is worth around 630,000 in 20 years from now. Definitely not a bad result.
No, great result.
Indeed, yeah. But if you can take a $500,000 asset that just grows even at a smaller capital growth rate, let's say 8% per annum over 20 years, the result is in excess of $2 million.
Wow.
Okay, so that's why we love property, because the leverage is better. In essence, putting less of your money with more of other people's money to be able to get a much better result over time. And that's even before you start to factor in the fact that you can leverage equity as you create it and build on that property portfolio to compound those results. But Amanda, why is leverage the X factor as we talk about it?
Oh, the X factor. Leverage definitely is. And, it's so powerful to be able to leverage other people's money or the bank's money to be able to get into property. And so many people think, when they first are looking into investing, that they do need to come up with a 20% deposit. Now, we all know how quickly property rises, and a 20% deposit today is probably, 3/4 of what you'll need in 6 months or 12 months to actually buy that same property tomorrow. So being able to take a smaller deposit and use more of the bank's money to get into property sooner will just mean that you can get capital growth sooner and actually be, using the bank's money instead of your money to build that asset and that price. So really important to be able to use leverage and understand good debt and bad debt and really be able to work that towards your advantage.
Yeah, awesome. And look, one of those advantage points is really around the amount that we can borrow. And my team and I are forever talking about 80 and 90% loan to value ratios with clients. And, in the popular media, there are commentators and viewpoints that are very much around 20% deposits, avoid LMI at all costs. And then there are the smarter investors that realize, yes, you have to pay some LMI, but on an investment portfolio, LMI is tax deductible, but it gets you a much greater asset base with the same money out of your pocket. So maybe just quickly for people, what is LMI and how does it work?
So LMI is something called lender's mortgage insurance. Now, it's an insurance premium that we as the borrower need to pay, but it actually protects the bank. So we borrow that money, it's capitalised or added into the loan amount, and basically that allows the bank to lend beyond 80% of the value of a property. Now, based on the Australian property market, the banks are pretty, comfortable lending 80% of the value of a property because they believe that, that's a really, a reasonable risk for them to take on. But if they lend up to 90% of the property value, well, then they're taking on a bit of risk because if for any reason, something were to happen and the bank needed to sell that money quite quickly, if they were unable to get all of their money back on that, then they have a bit of a problem. So what they do is they insure those loans and they take out a premium so that if for some reason the market price of the property doesn't repay the loan in full, the bank's able to claim on that insurance and to get that money back. So it's a premium that protects the bank, but the borrower needs to pay that.
Awesome. And so being effectively a loan cost, if you want to think of it that way, it is tax deductible for investment. And I'm happy to say that I've paid LMI on 80% of my investment portfolio, because if we think about it simply, if we have enough of a deposit for say 20% deposit plus costs, it's much better from a growth perspective to have that split into two and have two 10% deposit plus costs and incur two lots of lenders mortgage insurance. We're going to get so much more growth by having that second property compared to having one property with a 20% deposit plus costs contributed.
Absolutely. So it is all about that leverage. And, I say to clients regularly that, mortgage insurance can sometimes be the best money spent. When you look at it from a perspective of it might cost you $10,000 before tax, what you can own for that money, like you said, split the deposit, own a second asset, can actually just accelerate your, capital growth and borrowing power as well.
Yeah, awesome. So let's maybe quantify it for people. You and I talk about it every day, but if a viewer was taking a loan for $500,000, for example, how much is lender's mortgage insurance going to be on a 90% loan to value ratio?
So on a $500,000 loan, the mortgage insurance premium we'd be expecting would be around about $10,000 to $11,000. So not a large cost at all in the scheme of things.
Yeah. So if we just bring that back to the example that I said before, let's use 10,000 as a round number. And let's say that you're on, the 39% tax rate, then really of that $10,000, 6,100 is the real cost after tax. Two lots of 6,000 means that you're paying a collective 12K to be able to have a second property that's growing for you. I know properties that are going up by 12,000 a month right now. So unless you can save the extra 10% deposit in a month, lender's mortgage insurance is money well spent, as you say, sometimes the best money that you'll ever spend to be in the market earlier. It's really just taking a different mindset to it, isn't it?
It's taking a different view, and it's looking at, what that mortgage insurance allows you to achieve if you were to pay it. So, let's say a deposit is potentially, $150,000 if we paid 20%. It might only be, $80,000 or $90,000 if we paid 10%. So if you could retain full control of the rest of that money or not have to contribute that money, it's what can you do with the balance of those funds? And sometimes it could be a second property. Sometimes it could be potentially, a holiday or a car or, something else that, you might have been saving for. But yeah, it's important to realize that there are benefits potentially to paying that if you can use the other funds or, get into property faster.
Awesome. So now that we understand that lender's mortgage insurance is money that's well spent and leverage is powerful, or the X factor as we call it, how do we best harness other people's money to be able to get the best results?
How do we harness them? Well, I think looking at other people's money, like you said, it really just is a bank loan. So it's money that, I guess, for investment, we would consider that to be good debt. So good debt is something that if you borrow money from a bank, it gives you a result where it helps you to get a return on that money. Bad debt, and when we talk about bad debt or debt that we wouldn't necessarily want to leverage, is what we call personal debt. So it's debt where you might take out that loan to buy a car. You might take out that loan to buy some shares that maybe haven't been performing well. You could take out that loan to go on a holiday. But all of those things are either, depreciating assets or something that isn't actually giving you a return on your investment. And so we like to look at, I guess, good debt as things that actually get you into a stronger financial position, and investing in property is definitely one of the ways that leveraging other people's money or that good debt can help you into a stronger financial position.
Yeah, this is one of those great opportunities when Cam's not here to defend himself, because he's taken one of my sayings and claimed it as his own, which is, while you're building your portfolio, drive the cheapest car your ego can handle. And that's exactly to your point. It's bad debt, because why take out a loan and pay a lot of money out of your pocket for an asset that drops in value? That's exactly what we're talking about. But when it comes to investment property and good debt holding appreciating assets, I often say to my clients, think about each of these properties as something that not only does it grow in value, but it generates a $30,000 to $35,000 pay rise for you in the form of rental income from the tenants and tax benefits from the government, because it's tax effective good debt that you're not seeing today to be able to cover that debt. So I'm sure you probably see it every day. The traditional Australian mindset around debt is that debt's the devil. The reason for that is because the debt that most people have is the mortgage on their house. And the only source of cash flow they've got to be able to pay that mortgage is their own post-tax income. Whereas with this good debt, what you're talking about is being able to generate income from that good debt to cover the costs of it. And we can take advantage of the growth from there.
Yeah.
So I guess given we have an understanding now of those, the differences between good debt and bad debt, fundamentally we need to understand how we can maximize our borrowing capacity to take advantage of that. So can you talk everyone through why borrowing capacity varies from one lender to the next? And this really gets to the heart of why brokers are such a powerful part of your team.
Absolutely. So, Michael, every client that comes to us really is in a very different financial position. So no two scenarios are the same. And just like, everyone wouldn't want to go and buy the same car necessarily, it wouldn't suit everyone's needs. Taking out a loan from a bank also, the one bank is not going to suit everyone's needs. So different banks have got different policies, and those policies are really around the type of appetite that they have for clients and lending. So some banks have a niche and really like lending to, say, casual employees or borrowers that haven't had employment long. And there are other banks that say, look, we're just not interested. We're not interested in, taking the loan until, you might have 12 months in your job. So really important that, as brokers, we get to know our clients, really understand their goals and their plans, and also their financial position. So that just allows us as brokers to, review I think at the moment we've got access to about 57 different lenders, and just really understand out of those, which are the lenders that are going to maybe suit our clients best, and then match the policy to the client. Now, you mentioned borrowing power earlier, and, borrowing power can vary from bank to bank. The reason for that is those policies as well. So some banks add, different buffers on top of different things. So on top of living expenses, they'll also add buffers on top of our repayments. And one piece of news that we did get an update on this week was actually some updates that APRA, or the Australian Prudential Regulatory Authority, has brought out some new changes to how they see the lending landscape playing out over the next little while. So what they've said is that they're a little bit concerned that people are taking out debt levels above what they can afford, and they're looking to really make sure that two metrics are in place. One is that most banks are lending at a debt to income level of a ratio of 6. So that means that most clients are limited to borrowing no more than 6 times their income. And the second thing, as they've said, interest rate buffers now need to be set at 3% above whatever your actual rate is. So up until recently, they've been set at 2.5%. So that means if you were paying a 3% interest rate on your loan, the bank has been assessing your ability to repay that at 5.5%. Now, with the changes this week, which will come into effect as of the 1st of November, that'll mean a 3% rate will now actually be assessed at 6%. So in layman's terms, that really means that, your borrowing power is going to be impacted around about $20,000 to $30,000 less than you may have been able to borrow, last week. So the bank's tightening up on that a little bit. Now, in Australia, we do have 2 different types of lenders. We've got bank lenders that are governed and ruled under those APRA rules and regulations. We also have non-bank lenders. Now, those banks fall under ASIC, and they come under a slightly different criteria of lending. They still have responsible lending obligations to uphold, so that they make sure that they assess your lending responsibly. But the difference between the buffers that the banks may now have to apply and what those non-banks may be able to apply could mean the difference between somewhere between $200,000 and $500,000 additional borrowing capacity. So really important that, when you're looking at investment lending, that you see a broker that can help you to understand exactly what banks have an appetite for investors and exactly what lenders are going to help you to maximize that borrowing power, especially if you've got a fairly established portfolio and a number of properties, because those buffers on existing debt and existing repayments can make a world of difference, just depending on how they're treated and assessed.
Yeah, there's so much gold there in what you've just talked about, because there's a few key takeaway points for me. I'll try to keep them in order that you were talking about them. So the first was obviously the APRA changes. I think for those investors or potential investors that were looking in the market around 4 years ago, those restrictions were very much focused on trying to limit investor activity because of the volume of investor loans that were being lodged at the time. These restrictions from APRA have a very different motivation, and it's not to restrict investor activity because investment loans are making up a much smaller fraction of the lending landscape than what they were. Really what they're trying to do with this added buffer is just take the edge off the top end of the market so people can borrow a little bit less. So I think it's important to understand for the viewers out there that were impacted by restrictions 4 years ago. The word restrictions get used generally, but they're quite different in terms of what they're wanting to achieve and the amount of impact that we feel that they will have, at least in the short term. Who knows what might be coming later on. The second point that you talked about is fundamental. I can never quite understand it when I speak to people or my team speak to people and they're like, I've been with CBA all my life, or I've been with ANZ all my life, or Macquarie, or whoever, and I'm going to go back there. And it's like, right, well, if they put the stop sign on you, are they going to be paying you the growth that you're missing out on? I get it, right? That comes from the 60s when the bank manager actually personally signed off on your loan application. So having him or her on side was a really, key tool at your disposal. Now, when it's generally assessed offshore and, there are all these different offers in the marketplace, there's so much more benefit, and banks will throw so much more at new customers than what they will at existing customers. For those that are prepared to spend a little bit of effort and be a bit persistent and explore options and do this on a regular basis, the savings can be significant. I was actually talking to one of my good mates on the weekend, and he said, I can't be bothered, just like I'll go back to where I am. And I said, well, okay, what if it took half an hour of your time, right, to drive over to my place, but when you got here, I gave you a check for $4,000, would you do it? And he's like, yeah. I said, well, it's no different.
The same thing.
That's what some of the banks are offering. So yeah, it's got to be fit for purpose. It's got to be the right loan product, but absolutely spending a little bit of time and effort and being prepared to shop around and understanding the differences between the investment lending and loans, as opposed to, oh yeah, my broker does home loans, thinking that mortgages are the same thing, are very, very different, aren't they?
Yeah, absolutely. And I just, to add to your point, there is absolutely no loyalty in banking whatsoever. So the banks that, clients that have been with lenders for years upon years, we often see have some of the highest rates. Another example I'll give is I had a client this week who has a lot of lending with one lender, over $2.5 million. Now he approached that bank to lend him an extra $140,000, which was well within his borrowing capacity. But that particular bank made a decision that their risk appetite didn't want him increasing his total lending over $2.5 million. So they would rather that he refinances his $2.5 million loans away from that bank than to take on that additional lending. So just because a bank says no, it doesn't mean that the answer is no. It just means that your particular bank at that moment in time doesn't have the appetite or the interest for lending. So yeah, really interesting things going on at the moment, just with banks trying to play the game and follow the regulations as best they can.
Yeah, and look, it's I definitely don't want to come across as if I'm bank bashing, because I'm not, but we have a bit of fun with this, and we say that it's banks aren't in the business of lending money; they're in the business of risk management. And that's exactly what they want to focus on. But if we, I guess, just take what I was talking about before, really around the different mindset required around investment lending and looking at different banks, without doubt, the old school mentality on how we look at a loan is, what is the interest rate? As an investment lending specialist, who now runs a team and a very successful brokerage around investment lending, how important are interest rates, and where would you put them in the pecking order of important features when guiding a client towards a particular loan recommendation?
Yeah, so for us, interest rate comes absolutely last. So if we were to put together a checklist as investment specialists, the rate is kind of irrelevant. It's important and it's part of the puzzle that we put together, but it's definitely not on the top factors of what we look at when we choose a lender for a client. So the things that we look at, Michael, that we'll put higher up the list would probably be, first of all, valuations. Now, when you're trying to build a property portfolio, the equity that you hold in your property or the valuation result that we can get can sometimes be the difference between you being able to take enough equity out to duplicate it or to build a portfolio or not. Now, there are times when I can run multiple valuations and get similar results between lenders. There are also times where I can run, 5 different valuations and have results varying. I think one last week was $150,000 different, between the highest and the lowest valuation. So it can sometimes make all the world of difference, valuation results. So in that case, our biggest goal is to get the equity out, and so which is the lender that gives us the higher valuation. The second thing that we have a look at can quite often be turnaround times. Now, when we're investing in property and we're buying properties that can come under finance deadlines or contracts, just because the lender, who has the lowest rate is the lender that you might be drawn towards, that lender, especially some of the lenders at the moment, might have, 30 working day turnaround times, which just means it would be completely unachievable to get finance approved in time for your finance deadline. So in that instance, we need to pick a lender or have criteria in place where the bank's turnaround time is going to be able to deliver us on a result. So I'm yet to meet a client that tells me they're prepared to pay penalty interest or miss a settlement just to get a slightly lower interest rate. If I find one, I'll let you know. Another thing that we look at is definitely borrowing capacity. So we've talked about that over and over again, but borrowing capacity and being able to potentially, buy a higher value property or a property in a better location or something that gives you some flexibility around your choice of location can absolutely be something that we would consider when we're looking at which lenders. So that's really important. And probably another one to add in there would be policy. So we've talked about lenders' appetites, but also policy around different types of incomes. Now, Michael, if you were to earn, say, commissions or a bonus every year, some banks will actually take 100% of that income. Some will say to us, we're only going to take 80% of that or 50% of that income. So it can be really important to match the bank to that type of income and make sure the right kind of appetite's there, really just to give the client the best opportunity to borrow the most amount of money. So once all of those puzzle pieces and a couple of others are in there, then we kind of get down to, okay, well, what rates are on offer? And we'll start to talk about the products and the options with those particular banks.
Yeah, awesome. I was actually just thinking, my next question for you is going to be, so how can people maximize their borrowing capacity? What are the things they need to look at? I think you kind of answered that with regards to understanding which banks have an appetite for your kind of income structures. Not all lenders will use the same amount of rental income towards servicing. Not all will use the same amount of tax benefits. It really is a landscape that needs to be understood well to get the best benefit. And just a reminder for people, I mentioned off the top, click on the link below for the individual strategy session. If you're starting to realize how complex this world of investment finance can be, and even if you've had your borrowing capacity assessed, but it might not have been the best outcome or given you the borrowing capacity that you were looking for, get a second opinion, click on the link, and we can be in touch and give you some feedback on that. But just cycling back to interest rates that you mentioned at the start of your last explanation there, interest rates have come down, and they've come down a lot in the last couple of years. As you said, some existing clients of yours are paying well overs compared to current rates, just because we've got caught up with life and we haven't explored it or reviewed it. Absolutely, you're leaving money on the table if you haven't reviewed your interest rates in the last couple of years or even the last 12 months. That'd be the takeaway point for people that have existing loans, would it not?
Absolutely. I think, the lenders are consistently coming out, especially at the moment. Some lenders with cashback offers, some lenders are waiving annual fees for the life of the loan. So there's always offers on the table that we can consider. But more importantly, just the interest rate. I'm still seeing clients that are stuck on 4% interest rates when there are rates that are, in the mid 2% on the table for investment lending and low 2% for owner-occupied lending. So really important to not have what I call a lazy home loan that you never review and you never kind of, have looked at, but make sure that you're reviewing that every 12 months as a touch point, but every 2 to 3 years to really investigate pricing and other options would be my best suggestion on taking care of your loans and ensuring you're on the best rate most of the time.
Yeah, awesome, wonderful. It's right now. I've got another Cam analogy in my head that he talks about doctors. All doctors are medical specialists, but you don't go to a foot doctor to get your eyes looked at, and you don't go to an eye doctor to fix your foot. It's very much the same around lending and broking, right? A lot of brokers will be good at setting up a home loan, understanding what's required to take someone from 2 properties to 3 properties or 4 properties in an investment portfolio is quite specific. So some fantastic insights there. I completely agree, by the way, around interest rates being bottom of the pile. Valuations, you gave some examples around the variance in valuations that you've seen, and over my kind of 20 years in the industry, no doubt when you have GFCs and you have things like COVID, that variation is a lot greater than what it is in perfectly stable kind of economic and market conditions. So definitely something that has more relevance right now than maybe at other times in recent history. But why are valuations important? And stripping it back to basics for maybe some of the beginners watching, what is equity and how can we use it?
Okay, so to talk about valuations to start with, valuations really have to be done for every single transaction, and the valuation result is done by an independent valuer that doesn't work for the bank and they don't work for us as a borrower. So we place an order and an independent valuer goes out to value the property, and the result of that valuation is the amount that the bank will base their lending on. So let's say we're buying a property for $500,000. If the contract price is $500,000 and the valuation price is at $500,000, then the bank's going to lend us 80 or 90% of that $500,000 amount. Now, if the contract price was $500,000, but the valuation came back only at $480,000, well, then the bank's going to take the lower of those two. So they're only going to lend us 80 or 90% of that $480,000. So really important, I guess, for us and investment specialists that generally will do those valuations upfront so that we really understand what the result's going to be for that particular lender before we then put a hit on your credit file or we apply for a loan and go through all of that paperwork and process, which, is painstaking for anyone. So there's valuation results, and doing them up front and really understanding what value the bank's going to lend against will absolutely be key. Yeah, so equity is simply the difference between the value of the loan that you've taken out on the property compared to the value of the property. So let's say we have a $500,000 property and we have a $400,000 loan that has an 80% loan to value ratio. So there is $100,000 worth of equity in that particular property. Now the bank will only lend us up to 90% of the value of that property. So we could probably get around about $70,000 or $80,000 of equity out of that property. So equity is simply the difference in the value of the property compared to the loan that you've got on the property. So just the amount of money that we can borrow against to then take and invest that in another property.
Awesome. So look, while the landscape takes a lot of expertise and is very time consuming to navigate, and that's why you do it all day, every day, along with your team, there's nothing really in what we're sharing here that is rocket science or requires a PhD to get a great outcome.
No.
Yeah, it's really just mindset. And so one thing that I wanted to just help our viewers understand around valuations. I put valuations first, second, third, fourth, and fifth out of 5 criteria when determining which lenders I choose to use. The independent valuer, based on their insurance, has to be able to support the valuation that they're giving. So even though we see big variations in where valuations come back at, nothing is unreasonable in terms of market value. I think that's important for people to understand. Now, let's say that I got 2 valuations and one was 80K better than another one, for example, or even 50K. On the conservative valuation, if I'd just gone back to the bank that knows me or knows my stuff or makes it easy or gives me a good interest rate because of, our relationship or whatever secondary reason, then I might not be in a position to be able to move forward and get my next property. But by harnessing that extra value, the other valuation, if I can harness that extra equity and it gets me into another property, I'd like you to think about this. If you could have bought another property 15 years ago, how much difference would that have made to your wealth creation right now? And there's not one person that has ever said that saving 0.2% on their interest rate would have made them more than being able to access that extra equity to get into the extra property based on what it had grown by. So to be really clear, when we talk about interest rate being at the bottom of the pile, we're not suggesting a 5% or a 6% or a 7% loan. They're all going to be, within reason pretty close, aren't they? But it's really where we put the emphasis to be able to take advantage of building the portfolio and the compound growth that creates over time.
Yeah, and interest rates are so low at the moment anyway that, it really probably doesn't make that much of a difference whether we're paying 2.5% or 3.5%. Most of the properties, are really going to be positively, if not, at minimum neutrally geared at the moment.
Yeah, there's not one investment out there that we would be recommending to clients that A, doesn't have a capital growth focus, and B, is not paying for itself well and truly today. Yep.
Yeah.
Cool. So let's move on to, I guess, some of the barriers in the background that banks can implement because they love control and they like to be calling the shots. If you can detect the passion in my voice, this is something I came unstuck with 15 years ago and learned the hard way, and it's called cross-collateralization. I'm glad I got that out in one go. Can you explain to everyone what is cross-collateralization to start with, and why is it an issue for investors?
Yeah, so it's something that we see quite regularly, where a client's been back to their bank or they've used a broker where the broker's potentially not understood investment lending and taken them to the same bank that they used. And cross-collateralization is simply using 2 properties that you own, maybe your own home and an investment property, to secure your lending. Now that might be one loan account, it might be a couple of loan accounts, but effectively it means we've got one lot of loans secured across the 2 properties. So why that causes an issue is that every time you want to transact on that property, we want to take more equity out or we want to sell a property, we have to talk to the bank and ask their permission about both of those properties. So it can create some real roadblocks or hassles down the line if those properties are tied together. Now, the correct structure, or the structure that we would like to see, is to just take equity out of the existing property. It might be your own home or another investment property, and to borrow that as a standalone loan against that standalone property. Now, there are times when we do need to use the same bank, but where possible, we like to, mitigate risk and spread our risk between lenders. So we might take the purchase and that second property to a different bank, and we might borrow the rest of the money from bank B. So really important to speak to a broker or a lender who understands investment lending and the correct strategies and structures, because trying to untangle those cross-collateralized loans and help clients navigate that once it's all set up can be a bit of a minefield if you're not experienced in how to make that happen.
Yeah, absolutely. And look, that's something that my team share with people in our wealth creation consultations and strategy sessions, is exactly that. What are the finance structures that we talk about? Why are they important? If you're not familiar with why cross-collateralization is an issue, or specifically how you can harness the equity in your own home but not have your own home directly at risk. A lot of people have worked really hard, obviously, to get their own home and create equity in it. They don't want to have it directly at risk or all cross-tied. Again, click on the link. Our team will be in touch and we'll share that information with you for sure. One thing I'd like to move on to, Amanda, it's kind of dawned on me as we've been talking. We deal with this stuff every day. I'm sure that there are people watching that maybe yet to apply for a loan as a first timer. Maybe some mums and dads out there that did it 15 years ago and then life and kids got in the way and they haven't done it since. What's required to be able to access equity to start with? What's the process to get a loan approval? And what are some of those considerations or paperwork overload that people need to be prepared for when going through a loan application process?
Yeah, so two pieces of the puzzle that would, I guess, suggest that we can take equity out of a property. One, as we've talked about a couple of times during the webinar, is valuations. So first of all, we need to have the equity to borrow against. So if that's a green tick, we can move on to borrowing capacity. So if we have the borrowing capacity and the ability to borrow more money, well, then we can absolutely proceed with a loan application. Now, loan applications, depending on the lender, there are some banks that are actually making our lives much, much easier these days with the introduction of comprehensive credit reporting. So now that every single liability that a client takes out is reported on their credit file, the banks can now track on a monthly basis the total loan amount or the total loan balance and repayment history. So rather than us have to producing 6 months worth of bank statements to every lender, there are some banks out there now that will just simply look at a credit report and tick that box off. So things are absolutely moving towards, more convenience for people. But at a minimum, we'll need some ID, we'll need some income documents, be that pay slips or tax returns, some payment summaries from previous years, and then some bank statements. Really just understanding clients' asset position and any liabilities that they've got, and then their income and expenses. So once we get all that information back, we'll assess it and we'll do a quick review of their borrowing capacity and just advise what they can borrow, what lenders might suit, and then we'll have a really detailed discussion around their goals and plans and objectives before we move into an application process. So probably about an hour and a half worth of paperwork, initial gathering exercise, maybe an hour and a half of catching up with a broker to really understand recommendations, to get the right strategy and structure, and then really just signing some paperwork and letting us as a broker do all the heavy lifting to get the loan approved before we can move forward with obviously a purchase or have some funds released for equity.
Yeah, awesome. And I guess what are all of the different variables? You've undersold what a broker does in that process massively. What are some of those variables that can dramatically influence borrowing capacity? I'm talking about things like credit card limits and dependents and living expenses and so on, because the common perception I see among investors and potential investors is, oh yeah, interest rates are low, I've got plenty of money left over in my pocket, I can afford a property. Can you give some context and insight into that?
Yeah, absolutely. So we talked a little bit about bad debt before. So bad debt might be things like credit cards that we've either taken out and might be open but never used. They could be also maxed out. We could have car leases or car loans that have been taken out, and other types of personal debt that I guess can limit borrowing capacity. So just to give you an example, every $1,000 of a credit card limit takes away between $5,000 and $6,000 worth of borrowing power. So when I see a client that's got $20,000 worth of credit card limits, and that can sometimes just be a card for, a husband and a wife, they've got $10,000 credit card limits each, that can take away over $120,000 worth of their borrowing capacity. So really important that we investigate those things. We talk about what's needed versus what, is a like to have, and we reduce that bad debt. So sometimes we can consolidate some of those debts into home loans, be it car loans and leases, credit cards, but the goal is to minimize all of that personal debt to be able to maximize clients' borrowing capacity. So we'll review bank statements and living expenses. We'll have a bit of a discussion. For most clients, we can usually find a workable solution in the short term. For other clients, sometimes we'll put them on spending plans. And it might be a case of saying, okay, well, could we reduce these things? Can you stick to 1 coffee a day instead of 10 coffees a day, or do we need Netflix, and Hulu, all of the different TV options or entertainment options that everyone signed up to during COVID, or could it be an option that maybe we close some of those things? So what the bank's really looking to understand is, at the end of the day, what is the cash that's available in your pocket to repay a loan? Now, some of that's going out to credit card repayments or all of those subscriptions that we talked about. The bank's not going to be able to factor that towards a mortgage. So really important that we maximise every available dollar that will be available, so that we can put that towards borrowing power and show a bank that you've got the capacity to repay an additional loan.
Wonderful. Look, you've shared an amazing wealth of information with all of our viewers today, Amanda. Thank you. One last question. Obviously, we like to help people avoid making mistakes, whether that be the kind of properties that they're buying or the lending environment. What are some of the common pitfalls that you see people falling into?
Yeah, I think sometimes it can just be not factoring in some of the costs that come along with buying a property. So it could be that, they think they've got a 10% deposit saved. So if they've got $50,000, they think that they can buy a $500,000 property. But things that we need to factor in are all of the costs that go along with that. So it could be stamp duty, could be legal fees, could be some other, fees and charges that come along with that. So I think it's really important to speak to a broker and understand all of those additional costs, so that you can make sure we've got enough cash available to pay deposits. We also need to understand, just true borrowing capacity. Pitfall is clients go out and sign contracts before understanding that true borrowing capacity. So really important to be fully either pre-assessed or, have a broker give you a very valid, fully assessed, borrowing capacity just before going out and signing contracts. So really important that you ask a lot of questions to avoid some of those pitfalls that can happen before you're committing to making any purchases or signing any contracts.
Yeah, fantastic. So there we have it, everyone. Obviously, avoid cross-collateralization. Ensure you factor in costs associated with a purchase, not just allowing for the purchase price. And it might seem fairly obvious, but a lot of people don't do it on a regular basis. Understand your capacity before you start looking at properties, as opposed to buying something you love on the weekend on a whim and then hope that a broker can work some magic in the background. Amanda, thank you very much for joining us and all of your insights today.
Thanks so much for having me. It's been a pleasure.
So there we have it. That's the end of the webinar portion of property financing strategies. We hope you enjoyed it, but we're not done yet. Amanda's still with us, and I'd just like to say thank you to everyone who sent through questions in advance of the webinar. Look, we'd be here for the rest of the day if we were going to answer all of them. Some fantastic questions in there, but we'll work through a few that we've got time for, and on concepts that we think are going to be of interest to most of you out there. So Lee, over to you to ask the questions. But just while you're getting organised, I'm going to kick off with one for Amanda. Amanda, what is the current outlook for interest rates moving forward?
So as you've probably noticed, over the last few months, the RBA in Australia has held the interest rate quite steady. Now, most economists at the moment are talking about interest rates staying fairly stable through to 2022, potentially, at a cash rate of 0.1%, and then looking to have interest rates rise somewhere around the end of 2023-24, heading up to a cash rate of 0.25%. So we have seen in the last couple of weeks some of the really low fixed rates that are out in the market start to creep up. They've really only gone up by maybe 0.1%. So no real change to variable rates at the moment, but some of that cheap money that's been available to us on fixed terms for 2, 3 or 4 years is really starting to disappear at the moment. So interest rates definitely on the rise, but no great prediction that they're going to go anywhere too soon. Obviously, the caveat to that is, depending on what happens with inflation and some of the other economic impacts that can influence those decisions that the RBA needs to make.
Yeah, I think it's really important. It's obviously a question that my team and I get on a daily basis. And the way that I help people understand the landscape is this. Personally, I like it when interest rates come down because your cash flow is improved. I love it when interest rates go up. And people look at me a little bit funny when I say that. But if we think about the landscape and the cause and effect relationship here, interest rates only go up in response to a range of economic factors that have already happened. And so if we think if we think about when interest rates go up, the economy is moving in a positive direction. If that's happening, wages are up, people are earning more. If that's happening, property prices are up and rents are up. So fundamentally, if we're in a situation where there are some slightly increased costs to hold a property, but with investment, the rent has gone up and our tax benefits have probably increased as well, we're able to offset the majority of that cost increase, but we've seen substantial capital gain on the back of all of those positive economic factors. So yeah, it's a bit of a different story when it's just your own home and you're covering the mortgage repayment 100% out of your pocket. But as we've been talking about for most of the webinar today, the investment landscape's a little bit different. Lee, over to you.
Perfect. Okay, so Andrew would like to know, would transferring to another bank be a way of getting out of his cross-collateralization mess?
Oh, that's a really good question. I love cross-collateralization messes and cleaning them up. The short answer to that question is yes, provided there's enough available equity in your properties to allow us to untangle that cross-collateralization. So what I mean by that is, if you still have both of your properties, let's say there's just two properties tied together, if both of those are still at a 90% loan to value ratio, well then refinancing may not achieve that much because we'd have to pay some mortgage insurance again to change banks. So sometimes we could approach your existing lender, maybe to just do an internal refinance or restructure that lending, or it could be better placed just to leave those properties where they are until we get valuations back that indicate the total lending across those properties is less than 80% of the value of the properties. And at that point, it would be appropriate to refinance. So yeah, great way to untangle and uncross collateralize is a refinance. We just need to make sure it's the right timing to be able to do that and clear up that mess for you.
Perfect. James would like to know, how can equity from investment properties be used down the track to help fund a primary place of residence?
Awesome. Well, there's probably two components to that. There's maybe a little bit of me, Amanda, and then a little bit of you. So I'll maybe talk about the strategy part and you can talk about the actual process part. James, it's a great question. I think, where historically previous generations have been brought up to, save your deposit, buy your house and start to pay down debt. Today's generations are starting to clue onto the fact that having a principal place of residence for a 5 to 7 year period is a really expensive way to live because of the amount of money you pile into the mortgage versus the growth that is created. So a far more effective way to achieve the goal of having your own home, if that's what you want, is to rent where you want to live, build an investment portfolio and get the benefits of compound growth. If you're not crystal clear on what compound growth is and how to achieve it, click the link for the strategy session. My team will take you through it. But it is super powerful. Einstein called it the eighth wonder of the world. And unfortunately, 99% of the Australian population don't understand it. It's why they don't get the financial outcomes that the 1% of the Australian population who do understand it achieve. I used it, Cam used it, Matt used it, Al used it in terms of renting where we wanted to live, building an investment portfolio that then allowed us to be able to use the compound growth in the portfolio to buy our own home. There's no way that I could have bought where I live if it was saving a massive deposit and then dealing with a massive mortgage. But compound growth over a number of portfolios allowed us, a number of properties in the portfolio rather allowed my family to be able to achieve that. So Amanda, maybe the process of unlocking equity would be helpful for James?
Yeah, absolutely. So unlocking equity comes back to the key things that we talked about a little bit earlier in the webinar. So one is a valuation on your property or properties to ensure that there is enough equity there. So provided there's enough equity there, well then you can access that and we can leverage that equity to borrow to fund the deposit and costs for your owner-occupied purchase. So the other part to that is, of course, having the borrowing capacity to be able to buy that owner-occupied purchase. So important for us to make sure there's enough borrowing capacity there to have your properties valued and explore the amount of equity available. And then we would do the same thing that we would do if you were duplicating or buying extra investment properties. Just borrow the equity linked to or against the properties that we would secure that debt against. So that means the investment property that has the equity available, and then we would use that to fund the deposit and costs to buy that owner-occupied property. So really simple. It's not hard to get equity out to buy your own home or to buy further investment properties. Just important that we make sure that the available equity is there, and B, the borrowing capacity is there to enable that.
Well, it's a really good question, James. And one thing that I just add to that came to mind, the clearer you are when you start a journey on where you want to end up, the more effectively you will get there. So if you know that it's important at some point down the track to have the dream home for the family or whatever the goal might be, then it's far easier to get the strategy right from day one to be able to achieve that goal than if it's something that you just kind of decide last week and then try to manufacture that outcome from the portfolio that you've got. So it sounds fairly cliched, being understand your goals and how to get there. It's fundamental when it comes to property investment portfolios.
And I think just following on from that, it's really important with finance structures as well to understand those goals, because as we've talked about, different lenders have different borrowing capacities. So what we would seek to do if your goal is to take equity out down the track and have a high borrowing capacity to buy more properties, we want to place you with lenders that are going to enable that. So chasing the lowest rate, is obviously not our goal, as we've talked about, but it's really important to just holistically view goals now, goals over the next 2, 5, 10 years, just so that we can really set up a strategy that's going to allow you or enable you to achieve those goals that Michael talked about.
Perfect. Okay. Brenton would like to know how to know when is the right time to refinance and pull a line of credit on your properties.
So I guess looking at lines of credit, I'm assuming that question is probably talking to the conversations or the points that Cam makes in one of his books in relation to maybe living off lines of equity or being able to have lines of credit that can help to fund living costs into the future. So what we'd look to do is obviously to understand those goals at the beginning of your investment journey, so we can really plan around enabling that. As we're getting to a stage where you're maximising your borrowing capacity, it's really important to plan to take the equity out when you have the maximum amount of income. So I've got clients that are in really great paying jobs. They might have particular years or seasons where they're earning great amounts of income, but they know that they might be, in a couple of years, taking less hours, they might be changing jobs, changing incomes. So whilst that borrowing capacity is there, it would be a great opportunity to look at setting up lines of credit or borrowing extra money to enable those plans for the future. The other thing is, as you're getting closer to retirement, it's really important to be working with both a broker and a financial advisor to really help you understand, what those goals are and how much money you might need. So we can help you to really facilitate your goals, provided we know what they are. So either when you're getting closer to your borrowing capacity or when you get closer to retirement, it's really important that whilst your income is as high as it is going to be, that we maximise that opportunity to take as much money out as we can so that you can really get the most amount of equity out or have the highest line of credit available to you so that you can live the life that you're wanting to live into the future.
Perfect. Okay. Mona Lisa would like to know if now is a good time to invest in the property market.
Great question, Mona Lisa. Sorry for the brevity. Today's better than tomorrow. Yesterday's better than today. So buy when you can. I will caveat by saying that different markets have the right time to be investing in them, and not all markets are created equal. So don't make the same mistake that a lot of investors make around buying, in the same suburb they live in. You want to make sure that you're getting your property selection right, but absolutely with record low interest rates, with skill migration going to be coming back into the future, with the government support for strong housing market, with the construction boom that's happening. Absolutely, there are a lot of positives around the ongoing supply and demand dynamic around property and how we can take advantage of that for sure.
Great. Brad has asked, how do you plan ahead to anticipate different roadblocks in building a portfolio of properties and optimize lending ability?
I guess from a lending perspective, we really, as we've been talking about, those goals and objectives and really taking a holistic view are so important. The roadblocks that can come up are equity. That can be, a barrier to building a portfolio. Roadblocks that can come up are borrowing capacity. So things that we might want to plan around might be things like parental leave or maternity leave if there were family plans that were happening. Things that we might want to plan against or plan around would be borrowing capacity, and making sure we select a lender that, if you're wanting to duplicate and take equity out in 12 months, is going to be able to facilitate that. So really understanding the goals and the plans, and when you're seeking to be able to duplicate, if that's as soon as possible or if it's within a couple of years, we can really help to fine tune your lending and your borrowing capacity based around those goals, and I guess in conjunction with Michael and his team to help select the timing of those properties to facilitate the best outcome for you.
One thing that I would add to that, Amanda, is do what you can when you can. Especially around valuations, we talked about how valuer sentiment can change with the market. If you get a great valuation, that gives you equity. Even if you don't have the borrowing capacity for the rest of the purchase, establish the equity loan, and then you have the availability of the deposit and costs for when you do have the borrowing capacity. You'd hate to be in a situation where a valuation means that you've got equity to cover the deposit and costs for your next property. But if you don't take it out, only for the valuation landscape to change, then you're caught and you're not able to move forward. The other thing I'd add, Brad, would be consistent reviews. Okay, we talk about in Cam's book, and especially check sheets, around monthly reviews of comparable sales, 3 to 6 monthly reviews of your loan products, and so forth. It just gets you in a really good habit to ensure that you're actually doing what you can when you can, and not missing opportunities.
Great. Okay, Malcolm has asked, should he be looking to build equity into his investment property or keep paying interest only to free up cash flow?
Probably a question for you both to start with.
Love it. Yes, absolutely, Malcolm. Great question. Look, again, I'm going to be talking generally here. It'll depend on where you're at and what you want to achieve. But 99 times out of 100, the amount of extra cash flow that you have to put into a principal and interest repayment, even if the interest rate is low, means that you could be holding a lot more property with that available cash flow on an interest-only loan. So absolutely interest only. There's talk of if you have a principal and interest loan, you can be paying down debt. The reality is, when you look at the repayment curve, the majority of that impact happens between year 20 and year 30 of the loan. In the first 5 to 7 years, you're really making a very minimal difference in debt reduction with a lot of extra cash flow out of your pocket. So if you're still in an acquisition phase of your investment journey, strongly recommend interest only as the way to go.
Yeah, and there are ways to, like for clients who would like to be paying off principal, there are ways that we can actually structure their loans with offset accounts and things where we can get exactly the same impact of offsetting the interest on the loan, but we can retain full control of the cash to be able to pull that cash out in future to continue investing, or just retain control of the money. So rather than give all the money back to the bank when you've already borrowed it and done all the hard work to get that loan, just retaining control of that money, but also making your money work harder for you by having the right structure around your lending with potential offset accounts and things can really make a lot of difference.
Yeah, great. Okay, the last question from Daniel is, should investors invest through a business or personal accounts, and what are the for and against considerations?
I think I might leave that to you, Amanda, because it's all going to come down to the borrowing capacity and how you can get the loans, I think.
Absolutely. I mean, there's so many different ways to structure loans. We do look at loans definitely within company structures or within trust structures. What you need to know is that sometimes lending, if we're lending to businesses or to companies, can fall into a commercial environment. So the rules with commercial lending are entirely different to residential lending. So important for us to understand the reasons behind, I guess, the structure that you're seeking to borrow in, to actually advise whether that would be the right decision for you or not. Now, within trust lending environments, not all banks will use negative gearing, because the profits or the losses for those trusts are trapped within the trust and aren't able to be offset against your personal income. So if we're seeking to maximise borrowing capacity, then generally looking to potentially borrow within personal names can be a benefit, just improving your cash flow and I guess helping the ATO to pay for the part of the holding costs on your property as well. So look, generally there is no right or wrong decision. It's all based on your goals and based on, what the reasons are. Sometimes it's for asset protection reasons, sometimes it's for estate planning reasons where you might choose to buy within a company or a trust. So no right or wrong decision. Really important that you get the right advice though, because once you've purchased a property, selling that property or transferring the property between names does incur stamp duty. So important that you don't make the wrong decision and then have to untangle it down the track.
Wonderful. Thanks, Amanda. Well, I think that's what we've got time for today. Thank you again to everyone who sent through your questions. Some really great questions there that we've been able to answer, and hopefully some fantastic insights that you've gained from our property financing strategies webinar. Thanks again to Amanda, and again to everyone out there. If you haven't yet understood your borrowing capacity, or you don't know what your borrowing capacity is, click on the link for the individual strategy session. We can help get you some clarity on that. If you've started to build your investment portfolio and think that you can do it better, or you're looking to start your investment portfolio, again, click on the link and we'll be able to give you some pointers and some direction as well. But fundamentally, what we've got is a strategy that is not get rich quick. It does take time, but it's super powerful over the long term when you understand those property investment fundamentals. So my team will share all of that with you. Thanks again for joining us. Hope you enjoyed it, and we'll see you next month. Bye for now.